go with the screen. The, in addition to that, though, of course, we've got our president has kind of engaged in a little bit of an individual conflict with Turkey in terms of some, unrelated political issues, actually, which come back to tariffs as well, though. And so that has kind of pushed the situation further in that particular country. But as it, relates to other trade matters that, that impact other emerging markets, like let's say Mexico, for instance, you've got NAFTA. And so we asked the question, that kind of comes to the table, bringing politics back into it. Would a successful completion of NAFTA, would that make a difference in the emerging markets? Is that, would that help Mexico necessarily? So that's another question that we want to make sure that we talk about and take a look at.
One thing that's funny, Praveen, is that all the nerdy stuff that we talk about, whether it's the yield curve or interest rates or currency stuff, all of a sudden that's becoming in vogue because it's part of either Trump's Twitter feed or the context. I think I've been seeing multiple articles about the yield curve getting its time in the sun. It's kind of like fun. It's fashionable to talk about it all of a sudden, and people do get it. So all of a sudden Trump does see those articles too, right? And so he that's why you see that picture of the math on his face. I mean, usually he keeps it pretty lowbrow, frankly, talking about whatever he wants to, but he's been somewhat politicizing the same Fed that he said to higher rates, and it's time to do that. Now going back on his own ideas and kind of, rocking the boat with the Fed when they're doing a pretty solid job, slow walking rates on their own without his pushing them to. And then same with interest rates. He's been saying a lot, currencies. He's been saying a lot about manipulation of currencies by Europe and China. So, he's made so much progress, but then that same thing we've been talking about where, it's like 2 steps forward, 1 step back, some of his self-defeating behavior. And he's not the first politician to do that, but talking about manipulation of currencies when, the dollar's definitely in the driver's seat is a bit weird to me. You've got NAFTA coming in. Probably a lot of clients of yours are going to conflate the whole idea of the trade war with emerging market stuff. So, the first level of seeming smarter than your own client, which you always want to do, is to just say that those are 2 separate issues, not to be conflated. And so sorting that out for them automatically puts you gives you the intelligence gap.
All right. Well, let's drill in for a moment into hidden levers, and maybe we can take a look at if we can jump in there. And no, I think I've actually already got it open here. Let me hop out and hop open into my hidden levers. And what one thing I wanted to look at to show everyone a feature of hidden levers that's relevant to today's conversation. In our economic data center, which you can find up at the top if you log into Hidden Levers, under Data Center, under Economic Data, the first tab, which some of you may have looked at in the past, which is very relevant to a conversation like today, is called the Active tab. And this actually shows which economic levers are moving most rapidly. So it can help you get a sense for what are some indicators maybe that you weren't aware of that are moving fast. This top 5 that it's showing, actually, even here, we can see that 3 of the top 5 are emerging markets currencies. So we've got the Brazilian real dropping sharply. It's dropped 2.4 standard deviations in the last month, 10%, down 24% on the year. And if I pop open the chart, it becomes clear as day. Look at that drop. So that's just an example of some of the characteristics that the system is picking up on. Here with the Thai baht, we see that it dropped sharply as well, but lately has rebounded. And actually, that's what it was picking up on in the system. And then this is actually the Russian ruble. But if I expand the list for a moment, and these are organized by the degree that the rate at which they're moving, we see that the Brazilian real, Thai baht, Russian ruble, this is the South African rand, this is the Indian rupee. So in the top 10, roughly half are currencies. And then right outside the top 10, we've got peso and other currencies as well. So we see, by the way, this is interesting, Bitcoin, which typically is super volatile, right? It's not even in the top 10 right now. So as far as currencies, it's actually real emerging markets currencies that are the ones that are moving right now. And
of course, we do have that currencies tab, so you could just see them all against each other there.
Right. So specifically, absolutely, Raj. And so if you look specifically into the currencies tab, and there are other categories as well, But today, thinking about currencies, you can see at a glance what's going on with currencies on a trend line basis over the course of last month, last year, year to date as well. All right, so that's a quick look into the system. And Raj, if you want to, for those who don't have much time, maybe hit the quick takes.
Yeah, no problem. I'll give it to you in 2 minutes. Basically, the first big takeaway there in bright red, this hangover stuff, you're seeing the markets and how they're behaving. You're seeing all the over concentration on Turkey in the media, yet it's not doing jack to U.S. markets. And so that hangover in the EM, not a rally killer at all. That's something you should know. Perhaps your clients know it, perhaps they don't. The rest of the hour we'll be discussing why it's not happening, but brush that off your shoulders. You know, the EM hangover in general, a debt binge by an EM country, whether it was Russia in the late 90s, the whole Asian crisis, you know, the worst case it's ever been has been about a 15% hit to American markets, or maybe less than 10 even on most occasions. So on its worst day, that's what you're getting. This is a hangover if you have ties to Turkey or heavy interest in that country in terms of bonds or direct investment, equity market investment. You are feeling the same as the image for the scenario today, but just know that that's not going to cause contagion to the market. Hasn't happened. Don't think it's going to happen. More important than that, though, is the German kind of positive news of bailing out Turkey. You know, that is their little brother there. They're not in the euro just yet. Germany does want them. They share a lot of immigrant society there. But if they do set that lifeline in place, bailing out Turkey, taking it out of its woes, well, then guess what? There will be a line out the door for that kind of money. And so, you know, if that keeps happening, or if the German, you know, as they extend their credit, the euro is basically tied to German stability, right? We know that, and so as that weakens, there could be the opportunity for euro dollar parity. Praveen, if you could pop open the dollar euro chart, you know, you could see that now or later, but you'll see that we touched even 106, 105 on the dollar. You know, probably your clients that do travel, maybe they're empty nesters, are going to Europe, and surprisingly, it's cheap this summer, and so that's why they're doing it, you know, because that currency's cheaper than it's been in a long time, and there does seem somewhere in the technicals and somewhat the mechanics of what's on the table between Germany's lifeline, bailing out some of these kind of debtor slash debt bingers, you could say, that might take us down to parity, Praveen. I don't know. What do you think?
Yeah, it's certainly possible if they extend that lifeline, and if there's a lot of, one of the reasons they might do it as well is because a lot of European banks have been lending into markets like Turkey. And so that would, you know, set the stage maybe for the ECB to not be as proactive about ending their QE programs. So the moment that, you know, so it's been announced that they're supposed to end their QE program starting in December. If they never do it, then of course that weakens the euro, because that means that it's easy money for a longer period of time. So
Sure,
definitely a possibility there.
it is easier to talk about it, you know, a year out, right? Just to get your currency higher, but you know, that I would never call any of that manipulation, right? If they were going to manipulate, it'd be protecting the currency, not weakening. Okay, so let's talk about the you know, take a pulse check on the present day before we get into any kind of past analogies. Let's talk about the right now.
Yeah, so we talk about the right now, and we just start with you know, basic chart. Many of you would be familiar with the performance of some of the currencies. This is year to date. And what we want to look at is, if you start out and you just look at this line, this is when the Fed started. Well, first, you know, there's a rate hike announced in March, but also an announcement or indications from the Fed in the minutes that they were going to pursue as many as 3 or 4 more rate hikes over the course of the year. And so when that happens, that's when we start to see all of a sudden the real, it had decelerated a little bit from its highs on the year, but it's still above water for the year. And then all of a sudden it just goes into the tank, down 20% now for the year. South African Rand, it was actually up on the year, and then it starts decelerating down 13%. The rupee has been a little more steadily moving down in its march, but all three are down quite a bit. This is on the currency side. Now we ask the question, okay, this is currencies, but for U.S. investors and for many of your clients, to the extent that they have an international or EM exposure, how are they going to feel this? Well, let's look at that. If we jump back into hidden levers for a moment, I can actually go to the indices. So let's go to this index tab, and I go to global equity indices. We've got some of the major world markets, but we've also got MSCI emerging markets net here, and that might be a decent proxy for the question we're seeking to answer here. So this is charted with the S&P in green, and then here's the MSCI emerging markets in blue. And let's just look at that year-to-date question, and we can see that, you know, particularly recently, they really come unglued, with the S&P now being up, you know, 8.5% on the year. And, you know, there's been a rebound in the emerging markets in the last couple of days, but down at your low, down about 10%, and still down, you know, close to 6%. So that's a yawning performance gap. And a big part of this performance gap is what? Well, a big part of this performance gap is actually coming from the currencies. So that's a key point, you know, important for American investors to realize, is that most of these funds aren't necessarily currency hedged. So you're going to feel both on the upside and the downside. You're going to feel both the currency move and the move in the value of those local markets. All right, if we dive a little bit deeper now.
Praveen, do you think in some of these currencies, the bounce back is because kind of like there's this tendency in markets to throw out the baby with the bathwater? Those quicker rebounds, let's say Thai baht, you had mentioned that before. Can we expect to see any of that? A quicker rebound, just a bounce back in things that are not Turkey, that are not part of the European debt binge?
Right. Well, actually, and that kind of leads into the slide that we're looking at here in terms of all emerging markets are not created equal, certainly. So if you look at the very left of this chart, we see that some of these countries on a total debt to GDP basis, and this is including households in those countries, including corporations and the government, they actually have pretty low levels of debt, you know, and then you've got some extreme cases which are, you know, really, really quite a bit out there. And so, yeah, so all the countries are not created equal. Some of them, take India, for example, their equity markets have not been beaten up very much at all so far. And so you definitely have performers that are still doing okay. And then you've got, you know, those like Turkey, which are suffering far worse. And so, yeah, so there is going to be a country by country basis. And we'll get into, actually, we talk about what makes a difference. I wanted to talk about Turkey in a little bit more detail on this slide as well. So if the debt to GDP, and if we look at Turkey on this slide, well, they're at 104%. The average for developed markets, so that would be the United States, Canada, most of Europe, and so on, you know, Japan, 280% when you total it up across households, corporations, and governments. It's really pretty high compared to emerging markets. But so Turkey on that measure is low. So then why is Turkey having a problem? Isn't that the question we should ask? What's going on here? Well, there's two things. One is this upper graph here. So this is charted from the Federal Reserve. The blue line is GDP growth, but it's nominal GDP growth. So that includes price changes, that includes inflation, basically. And then the red line is their actual inflation. And why did I do it this way? Well, because it shows something interesting, which is that anytime the blue line is above the red line, those are good periods of high quality growth. And so all of this in here in the early 2000s, for the most part, they were actually growing very substantially. And then you start getting more recent, and, you know, you still have some pockets of growth balanced by some pockets where inflation is running faster, and so that's negative. But now look at the recent history. These pockets of growth are getting smaller and smaller and smaller, and inflation is steadily kind of rising to the point where its average might be above nominal GDP growth, which basically means you're in a recession. So Turkey's economic story is not looking as good as it was, say, a decade ago. That's story number one. Story number two, and this is really the big story that we've been seeing play out in the markets lately, is that they borrowed a lot of money in currencies that are not the Turkish lira. So when you borrow in your own currency, then worst case, you can monetize some of your debt. Essentially, you can print money to pay it off up to a point. Obviously, if you get into hyperinflation, like a Venezuela or a Zimbabwe, then that goes out the window as well. But to an extent, you have some control over the situation. When you borrow in euro and US dollars, if you're Turkey, and then all of a sudden the United States starts to raise interest rates, so money starts coming back into the United States as a result of, getting, now we're getting to the point where we're clearing 2% on, short-term rates, relatively, and so that's a reason for money to flow back into the U.S. So that is what's going to cripple Turkey, because all of a sudden their exchange rate, so the lira starts to fall in value, but they still owe the same amount in U.S. terms. So all of a sudden the debts get bigger and bigger from their perspective. That's
why they did it, right? I mean, it just hit me. You know why they did it. They didn't think it was a big deal because they thought they'd be welcome into the euro by now. And if they'd gotten across the finish line with the euro, then all that debt would be in Turkish currency, etc. Right?
Right, and that's an interesting point specific to, and that is an interesting point that's specific to Turkey. The general issue, though, of course, with the QE, that so many of these major central banks, so essentially the U.S., ECB in Europe, and then in Japan, the central bank, those three central banks were pumping so much low interest money into the economy for so many years post-financial crisis. So basically for the last 10 years, a lot of that ended up in emerging markets. And it seemed like a deal that was too good to pass up, where you could borrow money at, 2, 3, 4%. And so it seemed like a deal that was too good to pass up, but now they've, it's in the 400 billion plus range, which for an economy in a country Turkey size, that's challenging.
The funny thing is that, and this is one of our, if there's a fifth takeaway, Praveen, because there are several takeaways from this for EM, both Praveen and I come from that background from our Wall Street days, emerging markets, financial markets. And so I'll tell you, there's a tendency, especially in wealth management, to make a monolith of everything, right? China and all the BRICS are like one way, and the European emerging markets are one way. Even if you go to the Van Eck emerging markets, big tent, big growth funds, I mean, they just toss Spain in with Turkey. They toss China and India in, and a lot of them are big, mostly Chinese meat with a little bit of extra fixins of other emerging markets. But let it be known that Turkey here is pretty singular. They got caught on the other end. They're like the last European nation to not come into the euro. Basically, they're losing a game of Red Rover coming into the euro.
Mm-hmm.
And so that's why.
Yeah, so that's true, and that leads to this kind of risk where they have a lot of external debts that they don't have control over. And it's the same thing that in a smaller sense happened to some of the weaker nations in Europe, like Greece, who that's the the wrong story on the other side of the fence, which is that the euro is too expensive for them, and so. Right. But at any rate, this is,
if anything,
the trouble.
Turkey should have learned from that. Where they said, where you have Italy and Greece, definitely a lot of those people just wish they were never on the euro ever.
Yeah.
Because they could.
And the lesson to be learned here, if anything, is that a country, for a lot of these a lot of these countries, some of which have learned their lesson because of previous crises, but you should borrow in your own local currency when you issue debt, even if you've got to pay 8, 10, 12% instead of 3 or 4% in USD, because long term it's much safer when you have some control over it, and it's worth it to have that control. All right, so that was kind of looking at the debt load and where the risk comes from. Now here's sort of a long-term view. We briefly looked on HiddenLevers and saw that the MSCI Emerging Markets Index has been doing quite poorly this year. But we thought we'd look at full cycles, full Fed rate hike cycles. What does that mean for emerging markets equities? And actually what we see in some of this analysis is that the MSCI Emerging Markets Index is actually up 31% during the time period in the 90s when rates were steadily rising. And then 04 to 07, when rates were rising, the emerging markets were actually up very sharply. Now, of course, they crashed in the financial crisis. But the point here being that not every rate hike cycle has to necessarily be bad. And equities in particular, they tend to overall to perform along with other global equity markets. So, that equity correlation is there. Now, flipping over to the fixed income side, and I thought this was actually the more interesting takeaway for those of you, I'm sure most of you have some substantial fixed income assets on behalf of your clients that you manage, maybe not so much on the EM side. This was interesting. The notion here is that this is Goldman Sachs did an analysis from 2001 to 2016, so 15 years. And over that time frame, they found that a rise in the 10-year treasury for global, the global bond market as a whole led to a negative move in returns on bonds. That's not a huge surprise, right? That inverse relationship. But the interesting thing was that the relationship was very weak for emerging markets debt. So much weaker, and you can see the scatter plot, the dots are all over the place, much weaker relationship for emerging markets debt than for bonds as a whole. So rising US rates don't necessarily kill emerging markets bonds. Now, there are some reasons we'll talk about why this time could be different, but historically at least, that strong connection has not been seen.
What are those reasons that it might be different?
I think it comes back to that Turkey story. It comes back to QE. So if we talk about like what's different about the last 15 to 20 years, right? So in the last 10 years, we had the largest infusion of cheap capital sort of in history flowing out of these big central banks, Japan and Europe and the Fed. So trillions of dollars. Now, a lot of that money stayed in the home countries or it moved all over the world and it didn't all go to the EM, but the EM markets did absorb some of that cheap capital. As we talked about, the problem, of course, that capital is denominated in the wrong currency. It's not in Turkish lira. It's not in Brazilian real. It's not in South African rands. It's in the dollar or it's in the euro. And so as those currencies start to struggle, then there's a double whammy effect because you still got to pay up, but all of a sudden, the amount that you have to pay is rising against you. And as the investors are fleeing, the situation keeps getting worse. So it's sort of like textbook definition of something that can run away on you. If for every investor that leaves, your currency goes down a little bit more, and that means that you owe yet more. So yeah, that's why if there's a reason why there could be a problem today, that would be the reason.
Okay.
All right. Well, so now let's talk about the dollar as Superman, Raj, and you've got some good myth busting here.
Yeah, definitely, myths needing to be busted. I mean, there's an over-concentration in the financial media about Turkey, frankly, from what we see, and an under-concentration on the underpinnings of the American economy, and that's where the whole Superman dollar sign symbol comes in. If you were in Europe this summer or anywhere using dollars or converting dollars, you feel like Superman. I mean, it's like you're from a superior race almost, I'm just not. It's not a usual position for an American in Europe or American in Great Britain. But there's definitely myths out there that have come crashing down with this dollar rise. The dollar rise, everywhere there's a dotted line, that's because of a dollar rise right there. So here the first one is okay, people invest in Bitcoin. Oh, of course, Chinese people are buying Bitcoin. Koreans are buying Bitcoin. Those are emerging markets countries. It's because they want to get out of their currency, right? No, I think they're probably buying dollars. They're buying American real estate. They're buying art that's priced in dollars. Who knows? So, but that's far better investment because it's U.S. dollars. Here you see crypto down in the last 6 months since its highs in December, coming crashing down. That's the green chart there, Bitcoin. And Bitcoin's done the best out of them. So several of the cryptos have done much worse because of their own kind of the own cancer inside that industry. But let's say the best of the bunch, Bitcoin, is still you can see they're down compared to the U.S. dollar. So is it an alternative currency? I don't think so. How about gold? Tried and true since the times of Jesus and Muhammad. And guess what? The dollar's crushing it now. And so all that emerging markets wealth, where is it going? If it's money flows, it's all flowing into the dollar. So the answer to all these myths is it's money going into the dollar. Maybe not treasuries, but definitely into dollars. And so Mr. Trump's claims about currency manipulation, you're seeing that live there. The dollar against the euro and the Chinese yuan. What does a healthy euro look like? I mean, it's definitely far north of $1.16, $1.17 where it's been. And that's because of that downward trend, because of diminished GDP forecasts, and now the generosity of the Germans, and then kind of lackadaisical due diligence on lending to the banks, as Praveen mentioned, that that that's an absolute myth that they're doing anything to manipulate currency. Frankly, I would like them to manipulate currency to make their currency stronger. I mean, that would you'd wish they'd do that. They'd do some things, be more forceful, more hawkish, to mirror the Fed. It's that time in the cycle. So, but they're not, and so because of that, maybe dollar euro parity is a viable thing. Maybe not by end of year, but by maybe a year from now, I can see it happening. But definitely the dollar's in charge you see there, and so that's a myth. A new myth we're hearing just this past week, we've got new talk of some meeting of the minds between the United States government and the Mexican government. The peso, if you do have, whether you have wealthy clients that are cross-border, or whether you have wealthy clients that employ Mexicans, guess what? When they pay them, they're repatriating to Mexican pesos, right? So it might matter to them even if it's not their money. So that's where you really take a leg up in that bedside manner with a client, is see life from their angle. And so if a foreign currency is important to them, even not out of their own investments, it's the Mexican peso. They might be looking to retire from as part of the coastal exodus from these high tax states down to Mexico instead of Texas or Florida. In any case, that peso is now 19, touching 20. I think it even went into 20 handle, Praveen. But you see, this whole idea lately of, if there is an agreement, then that's going to take away the currency woes of at least Mexico. Forget the rest of Latin America and forget Turkey. Let's just talk about Mexico. It's going to heal that. And so NAFTA 1.0, that came out as a combination of George Herman Walker Bush, the Bush 43, and then during the Clinton administration is when it was really implemented. And you had an absolute peso crisis. They completely devalued their own currency. They had to create new coins to do it. And you can see a 60% just crash and against the dollar there in the Mexican peso. And that continues now. It isn't letting up just because there's a new NAFTA. So this is one of the things, your clients may do. I definitely have heard a couple of financial professionals do it, for better or for worse. They're asset managers. NAFTA should, and the whole trade war topic, just don't conflate that with the emerging markets currency woes. Those are two separate things. You'll look smarter when you do it with your client when they do it. And then also you can just call BS on the asset managers that are doing it. You can just walk away.
Yeah. Speaking of the asset managers, Raj, there's a question of GDP growth and which countries are really growing rapidly versus not. And
well, you see the charts. This is not us. This is from the IMF. If you click anywhere on this, we made it a hyperlink. Just click on that chart, bam, and you'll go to the website, Praveen. It is a super fun, interactive thing. For the due diligence folks in your investment committee dungeon, they'll actually have a lot of fun looking at this interactive chart. You can see, you can take that year backward and forward and see where growth is happening. Now you see all that green. That's not climate change, that's economics. So those economics are looking pretty good for a lot of Africa, Asia, the things that are, the emerging markets. And so, okay, if I have all that growth, geez, how do I take advantage of it? Probably you outsource some of your PM. So it made me think in terms of, I guess I could hand you winners and losers as general categories, and you could just name drop those things. But my suggestion to you all is ask your asset managers, and I don't just mean the Matthews Asia people or Van Eck or whatever has an EM concept in its statement, especially the SMA providers, because they are such a black box. I mean, ask them these questions. Is emerging markets one building, or is it a complex of buildings with different concepts, and how are you differentiating them? How are you doing something to take advantage of that, all the green there, the 10% growth rate, 6 to 10%, that's still double America's awesome growth rate. And so how are you taking advantage of that? But how are you preventing yourself from being a victim of the inflation in those countries? Which really is another way to say, what are you doing to to hedge out my currency risk, right? And if you've got structured products, maybe there's currency forwards or some sort of currency option in there, maybe things you understand or don't. But the point is, these questions will easily separate the wheat from the chaff in terms of your emerging market strategy providers. So, if you we're starting to get asset managers as customers a little bit, but we definitely want to. We don't just want free money. We could have easily put emerging asset manager advertising on our site from day one. We didn't do that. So, to do that in a proper way, we are here to be somewhat a gatekeeper for advisors on, be able to show what's good, what's expensive, where are those fees, etc. And of course, what's doing well and what has a heavy beta to bad things. And so this is a small question list on EM that you can ask those asset managers, and it'll let you know whether you need further meetings or you can just wrap up there. That's our
definitely helps start the conversation in a more pointed way, in a more in-depth way, rather than just sort of your standard generic checklist. So it makes sense. All right, well, moving into the heart of the matter, which is that, okay, now we've seen what some of the risks are and where it's driven from. What about emerging markets and the potential impact on the U.S.? Before we go to that, we have a question on whether or not real GDP growth equals good stock market, particularly in shorter time frames. I think it's a good question. So long term, and so you mentioned shorter time frames, but long term, of course, stock market growth must be correlated with essentially GDP growth underpins it in any country, right? So stock market can't really return much higher than GDP growth plus inflation, because of course stock market returns are nominal, they're not real. So you take real GDP growth, you tack on inflation, that's two of the three legs of returns. And then the third long-term chunk of return essentially is outperformance of the companies. Because remember, yield and stuff like that is still part of the return of the company. It's outperformance by selling to other markets. So a lot of U.S. growth, if we think about the U.S. stock market, it's growth because they're pulling in money from overseas, exporting. You've got a lot of U.S. multinationals that are all over the world, so they're pulling money in, and that helps their stock price. And then it's also are public markets absorbing or winning out over private markets to a certain extent. Anyway, that's getting into the weeds. Over longer term time frames, absolutely, you want to be invested in countries that are growing faster than usual. In fact, I know this is sort of a tangential question, but I'm going to go a little deeper on it because I think it's really interesting. And this isn't even an emerging markets answer to the question, but we've been looking at global equities today, so let's look at them. So the DAX is an interesting example. So the DAX is one of Germany's primary indices, right? If you look at the long term, we see that, everybody thinks that Europe grows slower than the United States. But in fact, the DAX has substantially outperformed the S&P 500 over the period of the last couple of decades. That's because the German economy is highly dynamic and it's growing faster than most of Europe over the long term. So that's just a concrete example of that story. Now, over short-term time frames, that's not necessarily going to be true. And, there's too many idiosyncratic factors. But long-term, yes, you do want to be looking at it. All right, so speaking of GDP growth, that was the topic, that we just sort of, explored a little bit there. Here's an interesting point. How much of U.S. GDP, well, firstly, looking at, we thought we'd look at, what proportion of the world is U.S. GDP today. And it was interesting to note that the world GDP distribution is equalizing. And so the U.S. is right around 24% of world GDP. The emerging markets, and this is excluding China, are another 24%. So, there is more balance than historically, when the U.S. was a much larger share. In fact, if you add up EM with China, you're close to 40% of world GDP. So the emerging markets as a whole are not small anymore. So that's sort of the first point. But then we take that same kind of point of view when we ask the question, but how much does it matter to the United States? So here on the right, we have U.S. exports to, I think we'll fix this in the slide, but Canada obviously is not part of the emerging markets. But if you just total everything from Mexico on down, then that's actually around 800 billion in total exports to emerging markets. And we wanted to look at the world this way, because we're asking the question, okay, well, how much does that contribute to U.S. GDP? And the answer is around 4%. So then you ask the question, okay, well, what if there's a true emerging markets crisis? Let's say that demand from emerging markets for U.S. goods drops by 25%. So then you're going to get a 1% potential 1% drop in U.S. GDP because exports shrink by that much. In the current context, given that the U.S. is growing and the growth is accelerated a little bit, that's not enough to put us in recession. That hurts, but it doesn't hurt enough to cause a domestic recession. So that's important. I mean, if our exports were to magically go to zero to all these countries, okay, yes, that will put us in a recession. But that's sort of the only way that's going to happen is if you have an absolutely sort of a global, catastrophic global recession. So that's sort of a larger.
That didn't even happen in the financial crisis. So I doubt that's happening.
Yeah, that didn't happen in the financial crisis. That didn't even happen in the Great Depression. So the chance of that happening in this crisis is basically nil. So yeah, the long story short here, it'll slow U.S. growth, but it will not send us into a recession by itself.
I do. Do you think if Canada was taken over by the Chinese, which it slowly is, do you think it gets counted as an emerging market?
It's interesting to see how these lines blur. I mean, to your point though, Hong Kong is not a particularly impoverished place, but we left it in the list because its economy is so closely tied to China, which is emerging. Another country that we sort of debated whether or not does it belong on the list or not was Singapore. We excluded it because Singapore is highly developed. But yeah, so increasingly you do have countries that sort of are on the line. Maybe historically they were developing, but at some point they become developed and are not considered part of EM. All right. Well, then looking. Go ahead, Rod.
Let's take a look at if you guys know how HiddenLevers scenarios are created, historical analogies form the basis, especially on the downside, of where we put the levers, especially things like a max drawdown in certain indexes and particular events that might smell the same as the current fragrance. And so we took three big events here: the Asian crisis in the late 90s and the Russian crisis on the heels of that. Some of you probably remember that bailout of long-term capital management, and maybe we're around for it. Maybe you read case studies about it, so it's not a rare thing to talk about. But in terms of the max drawdown on the American markets on the S&P, it wasn't even close in that Asian crisis. If there is one thing to compare it to, it would be that. And so 6% down on the S&P, even with the just 50% haircut in Thailand and Hong Kong, etc. And you compound that into that late 90s thing where there was a correction needed. It could have been the Russian crisis. Things compounded, and so that did take down. So you still have only 50% capture of the downside based on the fall of Russia, which did have somewhat to do with the fall of the Russian ruble. Did it not, Praveen?
Oh, absolutely. Yeah, it was a Russian sovereign default, and so the ruble, actually we were looking for, this is being in the late 90s, Russia's stock market was not well developed enough to even consider it here. So we looked at what's one of those major markets in Europe, which is sort of right next door to the crisis. And so that's our proxy for what was going on. But I mean, if you were to look at the actual Russian stock market, it probably went down 95% because the country defaulted on its debt. They devalued the ruble drastically. But even still, like you said, Roger, we see that insulation where the beta in the U.S. was higher, and that's in part because LTCM, a major U.S. hedge fund, which hedge funds were kind of a new thing or a newer thing at that time, and it blew up. And as a result, that maybe caused the shock to be a little stronger in the U.S., but still only a 50% roughly beta versus, something much higher like the financial crisis, where, as we see, Shanghai collapsed along with the U.S. during the financial crisis, and there you see the correlation going much closer to 1, as many of you would be familiar with. So on the spectrum of sort of these different events, really, we put the financial crisis in just sort of as a gut check, to see what happens in those extremes. But really, in terms of what we're talking about with emerging markets shocks, it's really somewhere maybe between these first two is more likely reality in terms of how that looks, even in a worst case. This
So what
2008
about
obviously being a global
upmarket,
crisis.
Praveen?
Yeah, that's a good question. And actually, we didn't include the chart, but it's interesting. So in 2008, or prior to 2008, Shanghai markets exploded upward. You can kind of see them up in the stratosphere up here relative to the S&P. So they had skyrocketed. Let me jump out for a moment since we've been taking a look at HiddenLevers, and we'll do it again. And if we look at the Shanghai market, we see, let me go backward in time a little bit more here. This spike, it's kind of incredible when we look at this spike, that the Shanghai market was up 5,300%. This is going back, a long time. But for reference, from 1990, the S&P was up, a little under 400% by 2007. Shanghai was up 5,310%. So if you'd been a global EM investor, for those of you who, don't have much, exposure to emerging markets, there are reasons to, right? That long-term GDP growth of China did drive their stock market, and even look at the long-term performance. The Chinese stock market's still way ahead of the U.S. So it does matter. But anyways, this is what we looked at, Raj, and answered your question, which is that this spike, zero correlation with the United States. This spike, zero correlation with the United States. Just, meaningless beta. So sometimes markets can get on their own sort of fever pitch rallies, and emerging markets can move faster than developed economies at times. And yeah, so we didn't see anything meaningful there. And you can see it in these sort of crazy peaks. That's the story of China, but that repeats over other markets as well. So,
okay.
So the upmarket betas, we didn't necessarily see, we saw less correlation than in the crises.
Okay, great.
Thinking further about crises and about like this present situation with Turkey, in doing our research, we found some of this and we just thought we would raise it. But how many times has Turkey been in the news in the last 15, 20 years with literally the same headlines in 2001, 2014, again in 2015, again in 2017? We didn't even include the headlines from this year because, there have been so many of them and you're all familiar with them. So it keeps on coming up as though Turkey is sort of having a crisis every couple of years. Meanwhile, what happened in the U.S.? Absolutely nothing. I can guarantee you, most of you don't remember any of this stuff because it didn't matter. And so that's sort of important to think about, when we think about the magnitude, looking back at the history. Now, as to that question of why might this...
More than any of our scenario analysis, more than any of our tech, I swear, just the cut and paste of all those headlines from the past 15 years, 18 years, that's all you have to show your clients to tell them, stop worrying about this. That's really it.
Yeah, absolutely. It really is funny when you look at that.
It almost
again,
makes
that's
me
the
think
research.
like the media is the culprit.
Well, and of course they've got to beat the drum, whatever the story of the day is, and keep people interested. Absolutely. We did want to explore the question of like, okay, this time is different, or famous last words in finance, but we wanted to ask, is it possible that there's anything that we need to know about or think about that could be different this time? The one thing that I really get back to, debt load, frankly, it's manageable, but really it's the borrowing in foreign currencies. And it's because the thing that happened that was different in the last decade that's new to the world economy is quantitative easing. So all this free money or easy money flowed out globally, and now it's starting to flow back. So that's a little bit new and a little bit different. If I had to point to one thing, that doesn't necessarily mean that there's going to be a crisis that has domestic impact. But if there were a reason, it's the same reason why frankly, it's sort of tied up with the whole Fed rate hike cycle, and if the Fed ends up going too fast in the U.S. anyway, seems like so far so good, but this would just be one more aspect of that. Not really different too. As we see, the Fed really controls the marionette strings quite often. All right, Raj, let's talk about the scenario which we put together several weeks ago as Turkey was really bubbling, and we wanted to make sure that we had an update in place.
Yeah, so the EM hangover.
Let's walk through it.
this was a new scenario for us, and because of the urgency of it, we released it even before the war room time. It has not had an impact on the markets though, but it is necessary in terms of coverage. A lot of times with scenario analysis and hidden levers, think of us as a way to raise and dismiss. Okay, here's what you care about, Mr. and Mrs. Client, and here's what's in the news. Let me talk about that for 2 minutes. Let me eliminate that as a fear, and then let me move on to the amazing things that I want to talk about. Right. So in this case, I would use EM's emerging markets bloodletting or the hangover as that 5-minute conversation and talk about the current outflows out of Turkey are right into dollars, and that helps us. So you have that as a baseline. You see that yellow ribbon across, and the U.S. domestic strength is really the dominant story. It should be in all caps when anything about Turkey should be lowercase. That's really it, because that. I mean, let's just face it. I think this is probably an upcoming scenario. We haven't talked about demographics in a while, Praveen, but let's just be honest. You've got the two largest generations in American history consuming at their peak, right? Boomers not dying and consuming,
Mm-hmm.
and and millennials coming into their own and buying and making babies and buying real estate, et cetera, et cetera. So all that, I mean, you and I sit in the middle of that as Gen Xers, but just seeing all kinds of consumptions around, planes full, brand new cars on the road every day, and just so all kinds of consumption happening, we don't really need anybody else, right? That's the American economy, and so that real underlying strength is the story that should probably be talked about more. But the smart money wants to keep that money off the sidelines and have the market climb a wall of worry, and then retail comes in when it's really at its last moments. We do have an upside and downside here. On the good side, the Fed could show mercy, and we really need to emphasize the Fed is in the driver's seat here. Should they listen or see what's happening in the emerging markets and just say, okay, well, despite what Trump says or not, we were going to take a break anyway and just elongate that rate hike cycle, maybe 3 quarters instead of 2, whatever that is. Any pause
Mm-hmm.
like that, and the emerging markets get a breather, because then they can
Right.
at least maybe get that U.S. dollar based debt into other currencies, or just trade it out, trade it away using their private bankers. There's a number of ways they can do that, and if we can get rates steady for 6 months instead of 3, I think they'll be able to have a little breathing room. On the downside, Praveen, go ahead. You have something to say?
Well, Roger, I was going to say, I suppose that, and we mentioned this earlier, but I'd add it here to this good scenario. It's possible that the Fed continues, but that the ECB, as another major player, sort of as a central bank, that they continue their easing, which would provide some relief. Not as much as if the Fed holds off, but it would provide some relief. So that sort of, or it's also possible that the Fed slows down and the ECB also slows down, which means that there's even more easy money on the table. But that probably only happens if something bad is happening in the world economy. So then you get into sort of a different mindset. But anyway, no, I think you're absolutely right that the Fed, showing mercy, so to speak, is it's the easiest escape valve.
I guess you were on that chart. There was euro debt that Turkey has, and so as if the dollar decimates the euro next, then at least Turkey owes less. In terms of their purchasing power in euros goes up.
Yep,
okay,
no, it's definitely that dance the currencies.
The bad scenario
to the next
here,
outcome, right?
Yeah,
Currency
why don't you
outflows.
talk about that? The U.S. is kind of the U.S. completely decimating a hobbled emerging markets landscape.
Well, I'd say the next the sort of baseline scenario, and it's not typically the case that we have our baseline scenario and our good scenario sort of aligned on the S&P 500. But in this case, we felt that appropriate because it's really about, in this middle case, which is sort of what's been playing out, is that the dollar is rising and the U.S. economy remains strong. And as a result, those are going up. But because of that rise in the US dollar, you are going to see international holdings and emerging markets holdings in particular continue to get beat up. So yellow in the sense that it's not great for global stock markets, but it's fine for domestic stock markets. But that's not the negative story. And so, Raj, if you want to paint that picture for us, how could it go?
Yeah, let's face it. The Caterpillars of the world, the Boeings of the world, they have their defense contracts, etc. in the Trump administration, so they've gotten a nice boost from that. But the multinationals of the world, they make their money abroad. That's IBM, that's Coke, that's the Dow 30, and we are at all-time highs on the Dow 30, even with emerging markets currencies getting decimated. So now just imagine their GDP actually going down. If you remember that map from that awesome chart from the IMF, the interactive one, with all the green on there, now what if that turned to negative, right? So if that does turn negative because the Fed keeps raising, they don't listen to what's going on, they don't have their ear on the floor, those exporters from America that are making more money over there, that could be Coca-Cola, that could be McDonald's. I believe McDonald's stock has doubled in the past year. I think we joke about some of these big Dow companies, just the easiest investment theses being the ones to play, that played out the best. And so those MNCs, all that money they made abroad, and that includes Apple Computer, I believe. So, they are exporters. And so the more that emerging markets GDP gets damaged because of the currency fallout, then that hurts them, and then that hurts us. So that ripple effect definitely hurts. It's basically the wheelchair of the crippled bricks kind of running over the feet of the Americans, multinationals.
Yeah, definitely. And that's with bringing it back to the context, I think that we had on the couple slides before, that kind of lines up with that idea of the S&P being down, as much as 20%. That's aligned with sort of maybe being similar to a Russian crisis, where you're talking about a substantial crisis in emerging markets terms, and maybe about half of that, impact in the United States. The other thing to think about, you were mentioning it, this idea of negative GDP, and we talked about that on the slide. We talked about exports, where something like a 25% drop in exports to the emerging markets, that does translate into something like a 1% hit to U.S. GDP. So it's substantial enough. It's not going to put us in recession, but it might be substantial enough to cause a correction in a market that's already, really leapt to new heights and new heights and new heights. So, that, would probably slow valuations for a minute, and that's how you end up with a mild correction.
Okay, are there any questions before we hop back into the platform and show you how to operate this scenario with HiddenLevers Toolkit?
Yeah, I'll go ahead and pull that up. So if we jump back over to HiddenLevers and we look under the Scenarios tab in the Scenario Library, we've got the EM Hangover here, and we can jump into it. And we see the three different outcomes: the positive scenario with the Fed pausing or showing mercy, currency outflows being that medium, and then crippled by U.S. rate hikes. And if we want to run any of these, then we'll upload the new slides. This is the previous iteration of slides from the last time we covered this a few years ago, and that'll get updated later today. But if we jump in, of course, we can run a stress test very simply. And for example, we can pull in our favorite robo-advisor portfolios just for kicks. We've got loaded into our sample account. Do we have a Wealthfront one? I feel like we've got a Wealthfront one as well. Let's see if we do or not. Maybe not. No, we've just, who knew Wealthfront had a mutual fund? That's interesting. They're trying every business tactic under the sun. But that's a risk.
That's too funny. I mean, just
that is funny. I had no idea that they got into that.
Go under, right?
Yeah, no, that's definitely amusing. So, but what we see here, I mean, just looking briefly at the scenario, as we had mentioned, as we pointed out, we see the negative 20 on the S&P and the big rise in the U.S. dollar, rise in of course, U.S. interest rates, because that's part of the overall story with the Fed continuing down its path. One of the risks that that gets driven by that, of course, is that you get very close to an inverted yield curve. So there's that kind of risk, as you were talking about the yield curve earlier, Raj. That's a risk, of course, in the U.S. as well. So, in looking at these results, we see that the outlier that stands out to me here, just glancing, of course, is actually the real estate side of the picture. And if there's excess risk in real estate, that would really be partly because of sharply rising rates as well. So excess risk there, and then of course excess risk in some of your emerging markets funds. So minus 28% here on this Invesco emerging markets fund in this example. And so that's one extreme. And if I go to the positive extreme, we see, again, green across the board, but you are going to see those emerging markets rally the fastest too.
Yeah, that's called a V-shaped recovery.
Yep. So that's the more rapid recovery there. All right. So definitely take a look at that scenario. And
if we go back to the website, Praveen, I do want to point out one of the newer features on HiddenLevers. This is something that we've all been clamoring for a long time, which is on the left. We definitely have these paradigm, the same one that the Fed stress tests do, which is a good, a bad, and an ugly outcome when you're concerning the same economic topic. That keeps your fiduciary duties in order, so you're meeting those. It also helps you check your ego in terms of what you think is going to happen in the world, and we just want to make that easy for you. Usually we do have the really pithy and easy to understand language to make that easy to frame the scenario, the bookends, and of course what's happening on the baseline. But now we've definitely gone ahead and iconized that for you too. So do give us your feedback on whether you think it's enough or whether you want to see more. We don't want to overcrowd our screens here, as so many screens, everything from Facebook to Betterment and anything in the middle, it just gets overcrowded eventually, that kind of feature creep. But we did want to put subtle things in there that let you talk about things as good, bad, ugly, and especially in our scenarios. I mean, this risk technology has been built in the biggest rally in history now, and so talking about the upside scenarios is just as important. We hear from Michael Kitces, or we hear from other sources that folks using some risk tools, they're putting their clients in portfolios that are kind of not risky enough to meet their goals, and so they're overemphasizing the downside. That's the last thing we want. I mean, you can see there Macklemore brushing his shoulders. I mean, it's on there twice for a reason, because this risk toolkit is to talk about opportunities just as much as downside scenarios. And so please do hear that. We try to emphasize that. So those green arrows on the upside outcomes are just as important as what's happening as risk factors.